Welcome to Talk Tickers, where we break down the earnings calls that really matter. All right, so today we're jumping into StoneX Group's latest results, and this quarter, it's a really interesting one. You've got this fascinating story of record profits, but the stock price, kind of just sitting there. So we're going to dig into why that is. We'll break down their huge RJO O'Brien acquisition, see how all the different parts of the business are doing, and then, of course, we'll give you our final take on where we think the stock goes from here. All right, let's get right into it. The headline numbers for this quarter, well, they really tell a tale of two completely different stories. So first up, the really good news. StoneX posted a record $85.7 million in net income. I mean, that's a solid 12% jump from last year. It really shows you that the core engine of this business is just humming along, firing on all cylinders. But, and this is a big but, here's the catch. For shareholders, all that impressive profit growth, it barely moved the needle. Diluted earnings per share, EPS, grew by just 1%. Yeah, 1. So what gives? I mean, how can a company post record-breaking profits, but the earnings for each shareholder stay totally flat? That's really the central puzzle we've got to solve for this quarter. And, well, here's your answer. It's all about share dilution. The company issued 3.1 million new shares to help pay for that RJ O'Brien acquisition. So you got more slices of the pie, right? That record profit gets spread out more thinly, and that's exactly why EPS just sat there. It's a classic case of taking some short-term pain for what management is betting is going to be a huge long-term gain. And speaking of that acquisition, it is the centerpiece of this quarter, so we've got to dig in here. Management isn't just calling this deal big, they're using the word transformational. And believe me, they are not mincing words. On the earnings call, the executive vice chairman, Sean O'Connor, basically set expectations sky high. He framed this as a fundamental shift for the entire company. So in their eyes, this isn't just about adding a business. It's about completely reshaping the identity of StoneX. Now, what's really fascinating here is how StoneX approaches these things. They don't just buy companies for the sake of getting bigger. Nope. They have this super strict 4-spec filter for any deal. First, it has to fit their ecosystem. Second, it has to create real value for shareholders. Third, the culture has to be a good fit. And fourth, and this is critical, it has to pay for itself, generating a positive return within 3 years. They run every deal through this checklist before they even start talking about price. It's incredibly disciplined. And they've put some serious, hard numbers behind that strategy. Just look at this. They're targeting $50 million in annual cost savings within just 2 years, plus another $50 to $60 million in unlocked capital after that. You add that up, that's over $100 million in real, tangible value they're promising to squeeze out of this deal. Okay, but let's be real. This isn't going to happen overnight. Integrating two massive companies is, well, it's a beast. It's a complex, multi-stage process. You see the first big chunk of savings coming in early 2026. But the really challenging part, the main event, is merging the two massive U.S. futures commission merchants. The FCMs that handle all the futures trades for clients. That's scheduled for late 2026. And you can bet that this is the timeline investors are going to be watching like a hawk. Okay, so with that big picture in mind, let's zoom in and see how this is all playing out across StoneX's different business segments. And wow, it is a real tale of two, or I guess 3 different businesses. The institutional side was an absolute powerhouse. I mean, income soared 73%. Commercial also had a strong showing, up 25%. But then you have the retail business, and it just completely hit a wall. Income dropped by more than half. So let's break that down for a second. The institutional segment, absolutely on fire. That was thanks to really strong performance in securities trading, plus that initial boost from RJO. But on the flip side, you've got the retail business. It relies a ton on foreign exchange, and it just got hammered by super low volatility. It's simple, really. When currencies aren't moving around a lot, there are fewer chances to trade, and that means, well, lower revenue. Okay, so with that as the backdrop, the Q&A session with analysts was really revealing. It gave us a much clearer picture of what management is focusing on for the year ahead. It really boiled down to 4 key themes. First, management is super optimistic about cross-selling. They're seeing a lot of early interest from RJO's clients in StoneX products. Second, interest rates. They're actively looking at how to hedge against falling rates to protect the income they make from that massive $13.7 billion in client assets. Third, they're confident that the strength we're seeing in the institutional business is the new normal, thanks to the RJO deal. And finally, they're not hitting the panic button on the weak retail results. They basically see it as things just getting back to normal after a few unusually strong years. So, after breaking all that down, the big question remains, what is our call on StoneX? And really, it all boils down to this one question. Is the prize at the end of the tunnel becoming the biggest non-bank futures brokerage in the US? Is that prize worth the short-term pain of share dilution and the very real risk that comes with trying to merge two giant companies? We think the bull case here is really compelling. There's just such a clear path to significant earnings growth in 2026 once those cost savings really start to kick in. Management has laid out a detailed and, more importantly, a credible plan to get there. Plus, their base of recurring revenue from all those client assets, it's never been bigger. And to top it off, their fortress balance sheet just got even stronger, giving them the firepower to go after much bigger clients they just couldn't land before. So for all those reasons, our rating on StoneX is outperform. We're predicting that the stock will continue to build strength as the market gets more and more confident that they can actually pull off this massive integration. Look, there are going to be bumps in the road for sure, but we believe the long-term value being created by this RJO deal is going to absolutely outweigh any of the short-term market noise. This is not financial advice.